A lot of folks have seen their favorite growth stocks hammered down 50, 60, 70%. Heck, I even talked about some Chinese stocks that are down over 50% on this channel. And so folks are wondering, like, well, wait a second, these are former Wall Street darlings, hyper growth companies in some cases, and they are just completely bleeding out. What is going on with my portfolio? That's what folks are wondering. If this is your first time tuning in, my name is Daniel. You're watching Unrivaled Investing, a no-hype mission-focused channel trying to find you exceptional companies and unrivaled investments. In this video, I want to address two aspects, two things for you to consider. One is what drives prices. What drives prices in the short term, long term, and then the second aspect is why do stocks ultimately go down? What are the key drivers where investors lose money? And so those are the two things that I want to briefly cover for you to consider. In full disclosure, this is not investment advice. I just wanted to, because I've gotten a lot of folks sort of saying, "Hey, Daniel, you know, I've been investing in XYZ, and I thought this was a great investment, and now it's down. Can you help me? You know, I know you're not invested, or I know you're not familiar with it, but do you know why I'm losing money here, or why my growth portfolio is down significantly? What's going on here?" And so first, let's understand what drives prices in the short term and in the long term. In the short term, what drives prices is liquidity. That means how much cash is sloshing around. That can be from stimulus that you get where, you know, every man, woman, and child, here's a check, go spend it. Or it can be from the central bank saying, hey, we're going to ease monetary conditions. Central bank is a big player. For example, the Federal Reserve had done radical quantitative easing, creating $120 billion in new, dollars each month, and that has had a radical policy that creates a lot of liquidity, and that would drive prices up. That's also why it's important to note that before every major stock market crash, you have some sort of tightening that historically that you've seen by the central bank, sort of saying, hey, we got to tighten things up here, and that squeezes money out of the system, and that drives prices. So short-term liquidity drives prices. Longer-term fundamentals drive liquidity. What do I mean by that? By fundamentals, I mean what's the yield that I'm getting? What's the cash flow that I'm getting? What's the growth that I'm expected to get? But a lot of people care about what is the cash I'm getting today, and what's my alternative? And that's the way a lot of people think longer term. In the short term, liquidity drive prices. And so if you have situations where folks say, hey, I don't really care about, getting that payment today, that's how things get bid up. You've seen a lot of growth stocks go from 5 times sales, 6 times sales to 30 times sales in the last few years, purely on this liquidity. Whereas the fundamentals, a lot of these, high growth companies, they trade at 30, 40, 50 times sales. They're hugely unprofitable. So when the day comes when folks say, hey, I need to get some cash, I need to see some positive earnings, that's when things start resetting. And a lot of it goes to sentiment, where folks say, well, wait a second, how likely is it that you're actually going to get those super high margins that I thought you could get? And that's a huge sentiment. Like when you're looking at hugely unprofitable companies and you say, oh, I'm going to value this at 50 times sales because I think this could be a 30% margins in the future. Well, that's a big assumption you're making. And any change in that assumption can lead to huge declines in price. So we've talked about pricing, short-term driven by liquidity, longer-term, medium-term driven by fundamentals. What's the actual business doing? What are they delivering for shareholders? The next component is, why do shareholders lose money? It really comes down to 3 components. The first component is valuation. A lot of folks don't realize it, but you can overpay for things. That's why it's so important to think about, wait a second, what's the optimized margins? What's the growth rate? What's the risk reward? That's why I try to call out a hypothetical framework in each video. So overpay, that's one of the easiest ways to lose money. Next, super easy, obvious way to lose money, too much debt. You have any sort of hiccup in the business and the creditors are knocking at your door saying, hey, pay me now. And if the company doesn't have the cash, you, my dear shareholder, you are out of luck because the creditors take over. And those are the 2 easiest ways to lose money in stocks. And so a lot of folks are waking up saying, wait a second, valuation is a huge component, and I'm starting to see that now. And some companies where it's like, hey, this company might not even have enough cash, they're going to have to issue more debt or issue new stock. That's also part of the reason why. And you're seeing a lot of companies issue a lot of stock now. The third way, and keep in mind, this is sort of a basket, how I think about losing money, is the third one sort of an umbrella term, which is just sort of general business risks. This can be shady management. This can be product concentration. This can be a hyper-competitive industry, where if you find a company that's competing in a very rivaled space, you're going to have trouble longer term because you might have a competitor that doesn't care if they're profitable. And if your largest competitor doesn't care if you're profitable, then you're toast. And so it's possible. Keep in mind, you can have companies that are sponsored by state governments that are like, hey, we are supporting this business no matter what. That's the reason why it's so important to me to try to find unrivaled businesses. I'm trying to find something that stands out from the competition that can win over time. Think about, yes, I definitely want to think about what's your growth, what's your optionality. Those are definitely components to it. But core of it is, are you unrivaled? And that's why each month from my Journey subscribers, I try to call out a company that I think has a very strong value proposition, potentially unrivaled. Right now I'm looking at a medical device company that, I think has, 600% plus upside. And it seems like they're unrivaled. They're treating something very specific for a subset of very sick patients, and there's no alternative. No alternative smells unrivaled to me. And so that's the broad picture of why are folks losing money, is because one is folks are starting to say, well, wait a second, the liquidity profile in the stock market might start to change as the Federal Reserve has indicated, yes, we are going to taper. So that means less radical quantitative easing. So that's going to start slowing down. Then maybe sometime in 2022, you might have a couple of interest rate hikes. So that means, okay, risk sentiment changes. Investors are going to say, hey, maybe I'll bid on the safest tech stocks. But you know what? All these smaller companies, yeah, they're not going to cut it. Or anything that's not delivering, I'm dumping out of it. I'm out of it. So that's what you're seeing in the short-term liquidity driving, short-term prices. Longer term, it's the fundamentals of the companies. And then those three key risks of why stocks decline, which is valuation, debt, and I'd argue business risks, which is an umbrella term. Thinking about how does the business operate, who are they competing with, what's management look like, and so on. If this video has been helpful for you, please make a point of hitting that thumbs up and hit that subscribe button. Thanks so much for watching.